Okay, hello and welcome to Books for Beneficiaries. My name is Pete Williams, the host of the program. Today I'm going to talk about federal gift and estate taxes. Now, this is normally a subject for the settlors with guidance to minimize these taxes on their estates. But I do want to give beneficiaries an idea of what goes on with these taxes because it may clear up some confusion, particularly when an estate is winding down. After all, any reduction of an estate value due to taxes, whatever taxes they are, but in this case, federal gift and estate taxes, means a reduction in an inheritance. Federal gift and estate taxes, they're taxes on the transfer of wealth. Gift taxes are taxes on transfer of wealth during life, and estate taxes are transfers of wealth on a death. An important thing to note is who pays for these taxes, both federal, estate, and gift taxes. It's actually the giver that pays the tax. So in the case of a gift tax, it's the giver that pays the tax. In the case of an estate tax, it is a tax that is owed by the estate based on the value of assets. Now, this is to be distinguished from an inheritance tax. Inheritance taxes are taxes applied to the recipient, the beneficiary, but those are in very few states, 5 states at present. There may be more in the future as state governments need more and more money. How much is the tax? Well, it's pretty hefty when it applies. The tax is generally 40% of the net estate over and above a certain threshold. Now, that threshold is very high, but the tax is pretty hefty as well, 40%. But let's back up a little bit. What is a gift? And that may sound like a stupid question, but the IRS defines it as a transfer of property by one individual to another while receiving nothing or less than full value in return. So that little last part is fairly important. For instance, sale of a car typically is not a gift. If I sell you a car and you transfer money to me and I transfer the car to you, that is not a gift, that's a sale. But suppose I transfer a car worth $100,000 to you for $1,000 payment. You give me $1,000, I give you a $100,000 car. So that's less than full value. So there's $99,000 that could be considered a gift. There's some other categories as to what is not a gift for gift tax purposes. There's some exclusions. Gifts between spouses are not considered gifts for gift tax purposes. It's unlimited marital deduction. You can give your spouse all the money, all the property you want, and there's no tax. And of course, all that does is bunches up the gifts, the estate, into the spouse's estate. So they may end up paying estate taxes anyway. There's 2 other important exclusions, typically from parent to child. A parent can pay educational expense and medical expense for a child if they pay the expenses directly to the institution. Also, charitable gifts are not considered gifts for gift tax purposes. And here's the important one. Gifts under $19,000 per person per year are not considered taxable gifts. When does the tax apply? Well, actually, the tax has a pretty high threshold for when it applies. It only applies when you've given away $15 million of wealth, either during life or at death. So, for instance, if a settlor writes a trust and they leave $15 million, there's no tax. Likewise, if during life, the settlor has given away $5 million of gifts, that's $5 million above the $19,000 per year, then the extra $10 million is available at death. So there would be no tax if the total does not exceed the $15 million. Now, we talked about the $19,000 exclusion every year, but if you exceed that $19,000, Even though there's not a tax, it's still a reportable event. So when to report? During life, when you gift an amount in excess of $19,000, you do not have to pay tax on that excess gift, but you do have to report it. And the amount in excess of $19,000 per giver per recipient, they report that amount on a form called 709, and the IRS keeps track of that. And that excess amount chips away at the $15 million lifetime exemption. So let's say the father gives son $119,000 in a single year. We know that the first $19,000 is non-reportable, non-taxable, and that extra $100,000 is reported to the IRS so that they know now that this person only has $14,900,000 left of their lifetime exemption, assuming father hadn't given prior gifts. So here's the summary. When to report from $0 to $19,000, there's no reporting and no tax. If you exceed the $19,000, you must report the gift. Up to $15 million, there's no tax. Once you exceed $15 million in giving, then there's a report and a tax on those gifts. You might hear the term portability. You may hear the term DSU, deceased spouse's unused exemption. So let's just say husband dies with a $5 million estate. That husband did not use the excess $10 million of exemption amount during life. Remember, he had $15 million he could use during life, $5 million estate. That means there's a $10 million excess. That $10 million can be ported over to the surviving wife, who now has $25 million of exemption on her estate. This is not automatic. The husband's estate must file a Form 706 to let the IRS know that his unused amounts are going to be transferred over to his wife. Remember, we talked about step up in basis. Generally, capital assets that are owned by an individual at death, all capital gains taxes forgiven, and the beneficiaries get to start over with a new basis in property. So this may explain why yours may have actually kept certain capital assets in their estate and not given them out, because they wanted to get that step up in basis at death. It's a very valuable benefit. And at death, what happens is the estate of a decedent, likely the person you're inheriting from if you're a beneficiary, the estate of the decedent goes to the ringer on the estate taxes. Now, remember, we're talking about a $15 million exclusion here, exemption. So we're only talking about, believe it or not, a very, very small number of estates in the United States. Very, very few people pay estate taxes because very, very few people, net, have a $15 million taxable estate. And if they do, they use certain techniques to lower the estate value. But what happens at death is not only are the debts paid off, but the estate is valued, everything is appraised, and that appraisal will determine whether the estate has an estate tax on it. If the amounts exceed $15 million, then there's an estate tax. And this is all reported on a Form 706. I hope this may help some beneficiaries understand what's going on behind the scenes when a settlor of an estate is doing certain tactics, and you're trying to understand why they're doing that. If a settlor is in an estate tax category, that's an estate well above the $15 million, they'll use lifetime giving. They'll give $19,000 a year. Spouses will combine and give $38,000 a year. They're doing that to get assets out of their estate because those assets may be taxed at 40%. There may be irrevocable trusts that are used. Charitable trusts are used. Generally, trusts that qualify as non-owned for estate tax purposes. Settlors will use generation skipping trusts sometimes. Believe it or not, there's actually an additional tax on generation skipping. And what we mean by that is the settlor skips sons and daughters and goes right to the grandchildren and makes gifts, either outright or through trusts. Of course, what the government wants you to do is people to die, leave it to sons and daughters. And then when sons and daughters die, they leave it to the grandchildren. And then when the grandchildren die, it goes to great-grandchildren. But there are techniques to skip a generation so that you can avoid taxation at each step. I mentioned life insurance being owned by a decedent will be part of the estate. So often life insurance, large amounts of life insurance, will be held in what we call an ILIT, irrevocable life insurance trust. And then the death benefit value of the life insurance will not be in the estate of the decedent because it is owned by a trust that the decedent did not have any interest in. And it goes on and on. There are many techniques that very wealthy people use to get assets out of their estate for estate tax purposes. Remember, it's 40%. And so attorneys are always coming up with techniques to have assets available, but not owned by the decedent. So if you're going through the inheritance process and you see some of these things going on, this is why they're trying to minimize estate taxes. Now, for those of you out there who think that, gee, I don't have to worry about this, a little word of caution. Inflation or hyperinflation can make estate very valuable. Now, I will tell you that in recent law changes, the exclusions and exemptions are pegged to inflation. So in theory, inflation should not affect you if the law stays the same. But be wary of inflation. People who thought they would never have $1 million and now their house is worth $1 million. Business success, an inheritance, a lottery for that matter. So be a little careful in thinking that this stuff does not apply to you. And then keep in mind too, if you're a beneficiary of an estate, some states have estate taxes as well as inheritance taxes. And inheritance taxes is where you as beneficiary may have to pay a tax on what you inherit. So I want to thank you. This is a quick overview of federal gift and estate taxes. I just want to make sure you know this information is not specific legal tax or investment advice. If you need that type of advice, you should seek out your own advisor who can determine your personal circumstances to give you advice in these matters. All right. Thank you very much. Until next time, take care.